Hi friends, in our series on demystifying Ind AS, we are going to talk about the key carve-outs that have been made while converging with the IFRS. We will also talk about some of the key carve-ins and key curtailment of options. Let us first understand what is a carve-out, what is a carve-in, and what is a curtailment of option. If you are to talk about curtailment of option, it simply means restricting the options. To give you an example, internationally, investment property can be valued at fair value or cost. So there is a choice which is available to the preparer of the financial statement. In India, this option has not been given and the investment property is required to be valued at cost. So this is a curtailment of option, since for the preparer of financial statement, the options have been curtailed from 2 to 1 or from fair value and cost to only the cost model. There are a number of curtailment of options which have been done in India while converging with IFRS. The objective was to prevent the abuse or also to ensure the consistency and uniformity in the presentation and preparation of the financial statements. On the other hand, a carve-out means that a different accounting treatment has been prescribed in Ind AS which was not there in IFRS. To give an example, at the time of the first time adoption of the Ind AS, internationally there is no option to continue with the carrying value of the property, plant and equipment. However, in India, while converging with IFRS 1, so when we made this Ind AS 101, this additional option has been given that if an entity so desires, it can continue the book value of its property, plant and equipment or the carrying value of the property, plant and equipment under its previous GAAP to its opening balance sheet. So this is a carve-out because no such option was given under the IFRS, but this is an option which is given under Ind AS. Now I give you an example of a carve-in. A carve-in means where no accounting treatment has been prescribed for a particular accounting transaction or an issue in IFRS, but in India, in Ind AS, we have provided that accounting treatment. An example is business combination under common control transaction. Internationally, in IFRS 3, no accounting has been prescribed for business combination under the common control transaction. However, in India, there is an appendix which has been added to Ind AS 103, which prescribes pooling of interest method for the common control transactions. So the idea was to give you the difference between a curtailment of option, a carve-out and a carve-in. Let us now discuss some of the important carve-outs which have been made while converging with the IFRS. The first and the foremost is the example that I gave, that an entity has an option to consider the Indian GAAP carrying values of its property, plant and equipment as the starting point for making its opening balance sheet on the date of transition. Please remember that once an entity uses this option, it will have to use it for all the items of property, plant and equipment. There are many people who feel that there's a choice which is available item by item choice internationally, but please keep in mind this is a carve out, so this option is not available item by item or class by class in India. This option is available for all the items of property, plant and equipment. The next big carve out has been regarding what we call as the para 46 and 46A of Accounting Standard 11, the effect of changes in the exchange rates. As we know, under para 46 and 46A of Accounting Standard 11, there is an option to capitalize the foreign exchange differences in respect of the long-term foreign currency monetary items. This option has been carried forward under the Ind AS also up to the date of adoption. So if a company is required to adopt the Ind AS from 2017-18, then it may choose to use this option of capitalizing the foreign exchange differences in respect of all the long-term foreign currency monetary items which the company undertakes on or before the date of adoption. That is, any long-term foreign currency monetary items which the company has up to 31st March 2017, it can make an irrevocable choice of capitalizing the foreign exchange differences. This carve-out will not be available for the future items, that is, the items which the company will acquire after its date of adoption to Ind AS. The third important carve-out is regarding the current and non-current classification of loan with breach of covenants. Internationally, if there is a breach of covenant in respect of any loans, and if the breach is not rectified by the balance sheet date, or the lender has not waived the compliance with that condition by the balance sheet date, then the classification of that loan will become current. Take an example, there is a company which has taken a 5-year loan on 5th of April 2016. On 31st March 17, there is a breach of one of the covenants of the loan, and that breach has not been waived by the lender, or the company has not rectified the breach by 31st March 2017. Then it will have to classify the entire loan as a current loan. In India, we felt this provision will prove to be quite a hardship for the companies. Hence, a relaxation has been given, whereby if the company rectifies the breach on or before the approval of the financial statements by the board of directors, or the lender waives that non-compliance before the approval of accounts by the board of directors, then this will be treated as an adjusting event, and the company will not be required to classify that loan as a current loan. The fourth important carve-out is regarding the straight lining of lease rentals. Typically, we see in India that the property prices in general increases, and with increase in the prices, the rentals also increase. So, for example, if you're taken a business premises today on rent, say at 1 lakh rupees per month, it's quite possible that after 1 year, the rent increases to 1,05,000, and after 2 years, it increases to 1,10,000, and so on. Now, this is to compensate for the inflation which is there in the country. Internationally, in some of the countries, that phenomena may not be there, and hence the requirement in IAS 17 is to straight line the lease rentals in case of the operating leases. In India, number of companies were facing hardship on account of this provision in the standard on the leases. Hence, while finalizing Ind AS 17, a carve-out has been made that lease rentals in case of operating leases will not be required to be straight line if the increase in the rentals is expected to compensate inflation which is expected. This is a big relief to the Indian industry. The fifth big carve-out is in respect of the bargain purchase. Consider an example. There is an entity which acquires another entity with a net assets of rupees 100, and the purchase consideration is 110. This difference of rupees 10 is typically capitalized as goodwill. Whereas if that entity has been acquired for 90 rupees, this difference of 10 is taken to the capital reserves. However, under IFRS 3, if the entity pays 110 rupees, while 10 rupees goes to goodwill, if 90 rupees is paid, this 10 rupees is not treated as a capital reserve, but rather is recognized as a bargain purchase, which is taken as a credit to the profit and loss account. To my mind, this accounting is flawed, because when excess consideration is paid, it is capitalized, and when the consideration is less than the value of the net assets, it's taken to P&L. It's fundamentally flawed. So in India, while converging with this IFRS 3, in Ind AS 103, it's been prescribed that the bargain purchase will not be credited to the profit and loss account. It will go either to the other comprehensive income or directly to the reserves, depending upon whether there was an evidence of bargain purchase or not. The next carve-out is related to the associates. Associates have been permitted to have different accounting policies if it is impracticable to have the uniform accounting policy. This carve-out has been made on the practical grounds. And finally, the foreign currency convertible bonds will continue to be equity. There will be no impact because of the foreign currency element in that. Let us also talk about some of the key curtailment of options. We already talked about the investment property. Next is in terms of the presentation of the profit and loss account. Profit and loss account internationally can be presented, the expenses can be presented either using the functional classification or the nature of expense method. However, in India, the functional classification option has been curtailed, and a company can use only the nature of expense classification. Similarly, the classification of interest and dividend in the cash flow statement has been kept consistent with the existing requirement of AS 3 on the cash flow statements. In the standard on the government grants can be set up only as a deferred income and cannot be reduced from the value of the fixed assets, although this option is being now relooked by the Accounting Standard Board of the Institute of Chartered Accountants of India, which has also brought an exposure draft on the same. And we already talked about a carve-in, which is a common control mergers, which will be accounted for using the pooling of interest method. So friends, these are the key carve-outs and the key curtailment of options and the carve-ins from Ind AS. One must keep this in mind that while an attempt has been made to keep these to be minimum, however, the idea was also to make the transition to Ind AS as smooth as possible for the industry, and at the same time also to prevent the abuse for which certain carve-outs were mandatory, like the bargain purchase, or a carve-in was, or a curtailment of option was mandatory, like the investment property. The option of fair value has been taken away. So thank you very much.